Thinking about just locking your business doors and walking away? Okay, stop right there. Welcome to this explainer where we're going to take some pretty complex legal statutes and turn them into a totally clear roadmap for safely closing up your Colorado business. Whether you're retiring, moving on to the next big venture, or just wrapping things up, we are diving into exactly how to legally and safely dissolve your limited liability company in Colorado.
So let's start off with a kind of terrifying reality. If you just stop operating and walk away without filing the right paperwork, your business isn't dead, it's a zombie. Look, a lot of entrepreneurs mistakenly think that if they just stop doing business, the LLC will just naturally dissolve on its own. But in the eyes of the state, an active LLC maintains perpetual existence until it is formally dissolved. And a zombie LLC is bad news. It just sits there, accumulating state delinquency fees, and actually invites creditors to pierce the corporate veil, which leaves your personal assets highly vulnerable. Think about it. If you fail to file your $25 annual periodic reports, the Colorado Secretary of State just marks your business as delinquent. And that status, it remains indefinitely. While delinquent, you're theoretically still on the hook for compliance, but the real danger here is that if you don't officially wind up your affairs, creditors can argue you basically abandon the corporate structure. No corporate structure means no liability protection, meaning they can bypass the LLC and go straight after your personal bank accounts. Yikes.
Okay, so let's dive into the roadmap to cure this zombie problem. We'll cover 1. Why formally dissolve, 2. Preparing to close, 3. The Colorado filing process, 4. Taxes, licenses, and creditors, 5. Common pitfalls and FAQs, and 6. Takeaways and disclaimer.
Section 1. Why formally dissolve? Stopping the zombie LLC. To really understand the urgency here, we need to look at what exactly happens when an LLC simply ceases operations without giving formal notice. It really boils down to this critical difference. Delinquent status leaves you indefinitely liable for reports and taxes, whereas formal dissolution legally ends your obligations to the state. Filing a dissolution puts a hard legal stop to your entity's active life. Once you file, the public is legally put on notice within 90 days that the company is no longer an ongoing business. That move completely shields you from future compliance penalties and provides a concrete legal framework to deal with any lingering liabilities. Moving right along to Section 2, preparing to close, the internal wind-up phase. Now, before you even think about touching a state website, you absolutely must complete the internal prep work known as winding up. You definitely don't want to just jump straight to the state forms. When you're winding up, there is a very strict chronological order you have to follow. You must vote based on your operating agreement, pay off all creditors, and only then distribute the remaining assets to the members. First up, check your operating agreement. What percentage of members actually need to agree to dissolve? If your agreement doesn't say, Colorado default law kicks in and requires the consent of all members. And hey, make sure to document this vote in writing. Next, you enter the actual winding up phase. This is where you terminate leases, cancel local permits, and collect any outstanding money owed to you. Now remember the golden rule here. Creditors always get paid before members. Always. Only after you've handled all your liabilities can you distribute whatever is left over to the owners. All right, Section 3, the Colorado filing process, making it official. Let's see how all that internal prep actually translates into the official state procedure required by the Colorado Secretary of State. People get this wrong all the time, so listen closely. Colorado LLCs must file a statement of dissolution, while Articles of Dissolution are strictly for corporations. This is a huge point of confusion. A lot of other states use the term Articles of Dissolution for basically everything, but Colorado is very specific. If you go searching for Articles of Dissolution for your LLC, you are going to end up completely lost or filing the wrong paperwork. You want this statement of dissolution. Oh, and a quick logistical detail, the Colorado Secretary of State does not accept paper filings anymore. The whole thing has to be submitted electronically through their online business portal. But honestly, the best part is the cost. Filing your statement of dissolution online costs exactly $10, and it processes immediately. Seriously, just $10. It's actually cheaper than your annual periodic report. When you pull up your business record online, you'll just confirm your principal office address, specify the individual who's managing the dissolution, and hit submit. Since the whole system is automated, your filing is processed in real time, the exact same day. Up next, Section 4, taxes, licenses, and creditors, post-filing responsibilities. The crucial thing to remember here is that filing with the state is not the end of the line. You still have to deal with taxes and creditors.
By properly notifying your creditors, whether that's directly or through a newspaper publication, you drastically shrink the window they have to sue you down to either 2 or 5 years. Under Colorado law, this is basically your ultimate liability shield. Think of it like a countdown clock. If you send a direct written notice to a known creditor telling them about your dissolution, they only get 2 years to bring a claim against you. Now, for unknown or future claims, say a latent product liability issue that pops up down the road, you can publish a notice of dissolution in a local newspaper where your principal office was located. Doing that triggers a 5-year statute of limitations for anyone to come forward. If they miss that deadline, their claims are barred forever.
Now, keep in mind, the Secretary of State does not talk to the IRS or the Department of Revenue. Filing that $10 statement doesn't just magically wipe out your tax profiles. You have to manually close out your federal, state, and local tax accounts. That means filing your final federal and state income tax returns and making sure they are clearly marked as final. If you had employees, you've got to file final payroll tax returns and close out state employer withholding accounts. Plus, make sure you log into Colorado Revenue Online to formally shut down your sales tax and retail delivery fee accounts within 30 days of closing the business.
Moving right along to Section 5, Common Pitfalls and FAQs. What beginners get wrong. Let's look at a few common traps that trip up business owners during the wind-up phase.
First off, do not distribute assets before settling your debts. And remember, even an anonymous LLC in Colorado has to fulfill federal FinCEN reporting requirements. If you pay yourself before paying your creditors, those creditors can actually hold you personally liable for the debts. Not good. Now, a great piece of news for Colorado filers is that, unlike a lot of other states, Colorado does not require a tax clearance letter from the Department of Revenue before you can dissolve. You can just file instantly. And finally, on the privacy front, even if you structured an anonymous LLC in Colorado using a Wyoming holding company, the new Federal Corporate Transparency Act still requires you to report your beneficial owners to FinCEN. State-level privacy just doesn't cancel out those federal reporting rules.
All right, Section 6, final takeaways and disclaimer, protecting your future. As we wrap up this explainer, let's quickly recap the ultimate roadmap to protect your personal and financial interests. Following these exact steps ensures total compliance and safely puts your Colorado LLC to rest. Vote internally and document it. Pay off those contracts and debts first. Go online and file that $10 statement of dissolution. Separately close out all your tax and licensing accounts. And make sure to issue your statutory creditor notices to limit your liability. Oh, and definitely keep all your records for at least 7 years, just in case an audit ever pops up. Now, because winding up a business can involve some pretty complex tax and liability issues, we strongly encourage hiring a legal or financial professional to guide you through your specific circumstances. Every single business is unique, right? So if you have multiple members, outstanding debts, or complex asset distributions, an attorney can really help ensure you don't accidentally leave yourself personally exposed. Keep in mind, the information in this explainer is intended to be general information only, not legal advice. So, is your LLC fully closed, or is it just a zombie waiting to wake up? Take a look at your records today to make sure you aren't leaving the door wide open to future liabilities. Don't let a zombie business haunt your personal finances years down the road. Take the proper steps, file the right paperwork, and close out this chapter with complete peace of mind. Thanks so much for joining me for this explainer. Now go out there and protect your future.